Okay, so the first part of this is a trend analysis of net sales revenue and net income. And it's saying use 2021 as the base year. So I will do net sales revenue and net income. So I'll just use formula. So first I have to find net sales revenue. So it's this line here. So I'll take the year I'm uh, trending, so 2025, divided by the base year. And it said use 2021 as the base year. And for my formula, I want to fix the base year on 2021. So I'm going to go to J8. You can press F4, and that kind of puts those dollar uh, symbols on J8. So now J8 is fixed. So now when I apply this formula rightwards, you can see that it moved the top one to the right because it did not have those dollar signs, but it kept the base year on J8 because of the dollar signs. It just did that for all of these. And you can see in the last one, it's just J8 divided by itself. Um, so that's why it's 100%. Okay, and then we can do the same thing for net income. Just go find net income on here, which is right here, row 18, divided by the base year. And I fix the base here by putting the dollar signs. Oh, okay. So why did it not do anything? Well, it's because um, this is formatted as text. So it's not understanding that this is a formula. So what I can do is go to this cell, change it to general, and it still didn't do anything because I have to kind of refresh it. So I just double click back into the cell, and then I can convert this to a percentage using this formatting. And then I can do Control R. Okay, so this is requirement one is done. So what can we say about the trend? Has it been good or bad for this business? Has it been doing well? Yes, it's done really well. Okay, it's grown revenue. It's doubled its revenue, right? It's at a little over doubled, but it's almost 8x its net income. Now, how is that possible? How can you have a doubling of revenue and it's leading to 8 times more income? Shouldn't do they necessarily go together? Well, clearly they don't, but why is this possible? Expenses went down or yeah, just didn't grow either, right? So for example, if we had 800 and 100, so this is year one and this is year five. Sorry, let's make this 200. And in this case, we had $80 of expenses. So this minus this is 20. And let's say our expenses didn't change at all. Okay, so you can see here that our revenue doubled, but since our expenses, and again, this is revenue, this is expenses, and this is net income. So you can see that the revenue's doubled, but our profit has gone 6x, right? So this is what these trends are the trending information is telling us that we had some kind of economies of scale, meaning that we were able to increase revenue without a linear increase in expenses. And that's going to lead to a much larger profit. Okay. So that's why like a business that buys some factory, like a machine, right? If they only make one machine out of the thing, it's like they're not going to be that profitable. But that one machine can also make 1 million items. Okay. So if they can sell the 1 million items, their profit is going to be a lot because kind of their fixed expense of that machine is just a one-time thing. So there's economies of scale. This is kind of when people talk about economies of scale, that's what they mean, that the expenses don't grow linearly with revenue. You can use the same assets to generate much more revenue if you can sell the product. Okay, so let's just do this next one. Profit margin ratio, net income divided by net sales revenue. So this is going to be our profit margin, also called the net margin, okay, because it's the net income or the net income margin. So it's going to be equal to our net income divided by our sales revenue. So this one doesn't need any dollar signs because each year the ratio is calculated independently. It saw how much profit we made given a certain amount of revenue. And so again, we'll convert this to percentage, apply this formula rightward. So you can kind of see what is happening here. This trend line is reflected in the profit margin too. We're just making, for every dollar of revenue, we're keeping more of it as profit as time has gone on. So these two you can see are kind of related. Okay, so let's keep moving forward here. Rate of return on total assets. So on one hand, yes, they're giving you the formulas and you can just like use it and just, crunch the numbers. But let's think about why this formula is the way it is. Okay, so net income plus interest expense. So net income as just by itself is including interest expense. So why are we adding it back? What this ratio is trying to get to is using our assets. How much income are we generating? Okay. Now, that question should not matter how we finance the assets, whether we borrowed money to get the assets, whether we financed it fully with stockholder equity. That should not sway how well our assets are performing. Because again, as we said, assets equals liabilities plus equity. The assets are probably is like operational. How good are we at using those assets to generate profit? Now, the CFO, the chief financial officer, might have been like, we're going to borrow a ton of money to get the assets. And that's going to really increase the interest expense. The COO, the chief operating officer, they just care about how they're using the assets to generate profit. And that's the important thing. So we want to normalize the profit for the financing decision, right? So we're going to add that back because we want to see how much profit is generated irrespective of how the assets are financed. Because that's the more operationally important question, because we just care about how good are we using our assets to generate profit. We will go to net income, which is, again, here, 23,070. We're going to add back the interest expense. You can see here that it's a negative number though, so we can't just do plus this. Okay, so this is, again, you have to understand the meta of what's going on here. If you just did F18 plus F15, it's going to actually subtract net income or interest expense again. Okay, so what we actually want to do is subtract. Okay, let's just do this. If we just did net income plus that cell, it's actually going to lower our net income, and that makes no sense because what we're trying to do is figure out what our profit was before paying interest. So you have to actually do this as a minus sign. And now we have our net income before paying interest. And that's going to be divided by, and it's actually not exactly right because interest, in this case, I don't think we're paying income tax, but if there was a tax expense, they need to also have to adjust for that because interest expense lowers how much tax you have to pay. So you'd have to do some adjustment there too. But I think in this problem, you don't have income tax expense, so we don't have any kind of adjustment for that. But just for your knowledge, if you're trying to get a pre-expense profit, you also have to realize that the interest expense is going to affect how much tax you pay because it's a deduction from your taxable income. Okay, but that's kind of a technical thing. But let's just follow the formula as they've stated it. Now it's saying the average total assets. So throughout the year that we've generated net income, the amount of assets that we have has changed every day, right? We have cash coming in, cash going out. We're buying assets, we're selling assets. And so the shorthand way, you technically would want some kind of moving, like some kind of weighted average per day or something. But what the shorthand is to just take the average of the beginning and ending balance of assets. So what we do is take the average. There's a function called average. I go up here, you can see that our total assets at the end of 2025 is 107,300, and at the end of 24, it's 95,000. The end of 24 is the same as the beginning of 25. Okay, so we're just going to take the average of these two. That's going to give us the average of 2025, essentially. Beginning balance and average and ending balance, the average of that. Okay, so again, my formula is now um, net income, and we're doing minus F15 because again, F15 is recorded as a negative number. Okay, if F15 was a positive number, then we would do F18 plus F15. Okay, but since it's in the cell as a negative number, we're going to change the sign and make it a positive. Okay, so now if we convert this to a percentage and this apply it rightwards, you can see here there is a little problem with 2021 because you can see here there's no data for 2020 as to what the ending balance was for the assets. So though the formula gives you a number, just be a little mindful that it's not quite accurate because we're missing some data. Okay, it's just using the ending balance of 2021. Okay, so look, you could have saved some time by just using this right here. They actually just gave you the information here. Okay, but now we saw how to calculate it, so even better. Okay, so you can see here the trend is also really good. We're we're generating more profit using whatever assets we have over time. We're more efficient with our assets. Okay, in this first year, we were only getting a 7.4% return with whatever assets we had. In this last year, we're generating almost 24%. Okay, so that's really good. And it's kind of like irrespective because you can see we're having, not only are we getting more efficient with our assets, we're also growing our asset base, right? So it's like a double benefit. Not only are you getting more efficient with the use of your assets, you're having more assets that you're using to generate profit. So these are both positive trends. There are some companies that will acquire businesses and their assets will grow, but the efficiency will go down because they're just buying these extra assets, but they're not getting much return from them. So their asset efficiency drops. Okay. As a business owner, you can always increase your assets to get more profit. You can just raise money from your shareholders and then put it in a bank and make 1.5% or 2% or whatever the savings rate is, right? You're going to get some return. But the question is, without a good use of the capital, right? The shareholders are not going to be happy that they're investing in your business, giving you capital, and you're just putting it in the bank and earning a percent and a half. Because they could have maybe used their capital to invest in a higher return investment. Okay. So just because you see assets growing, that's not enough information. You need to see how efficiently the business is using those assets to generate profit. Okay. So this is the whole game of capital, the capital markets. What investors are doing is they're trying to figure out, given a level of risk, what is the highest return that they can get. Okay, this is why when the interest rates change, if the federal government, if the Federal Reserve Bank, I should say, raises interest rates, that resets everything. Because maybe you were owning some risky real estate property and getting 4% return. Now, if interest rates go up, you can put that same capital into a government bond and get 4%. Okay, so then you're going to require a higher return from the real estate investment. So this is why interest rates are so expensive, like so critical to the economy, because they're really setting the return expectations for investors. And that's why they're so closely watched, and they can move our entire economy and shift everything around. Even when they started raising rates in 2022, 2023, that affected venture capital, right? Venture capital firms, they started getting less money that they can invest into venture capital because the flow of investments shifted so much to less risky assets because you could get a higher return. Okay, so it's all linked together. Okay, so that's just a little aside on what return on assets means, the interpretation. Um, so let's just do this last one. Or I think these two are repeats. So let's just delete that. Asset turnover ratio. Okay, so instead of looking at the profit that you generate from your assets, this asset turnover ratio is looking at how much revenue can you generate. Okay, so this is a kind of bottom line uh, metric or efficiency. This is a top line efficiency, meaning how well you're using assets. Profit in the end is more important, but in certain contexts for like growth stage businesses, it could be more important to know how well you're generating revenue with your assets. Okay, so um, it's pretty much the same except we're using revenue instead of net income. So you just use this divided by the average of your total assets, which is these two. Okay, so you can see that your asset turnover ratio is also increasing, meaning that you've been better at even generating sales revenue using your assets. So um, this company clearly is performing better over time. Okay, we can see it in all these different ways. Okay, so let's keep going here. Rated return on common shareholder equity. I don't know, this is messed up. This should be 2025. The years are a little messed up here. I don't know what's going on. You take the net income, which is again this cell, F18. There's no, at least from what I see here, there's no preferred dividends. So we don't need to do anything with that. There's no, maybe we don't have any preferred stock. And then we're going to divide by the average of the equity, shareholder equity. So just these two on line 29. Okay, so that's as we call it, the book value of equity. This represents contributed capital plus retained earnings. Apply this rightwards, and I think this is probably not going to work. Or this one, yeah, there's no last year's data, so this last one is not really um, quite correct. This 8.35, so I'll just delete it. Okay, yes, maybe they gave it. Okay, and the rest of these should line up. Let's see. Yeah, looks like the rest of these are correct. Okay, and then earnings per share. Again, they gave us actually earnings per share. It's given to you right here. Per share of common stock. It says, and again, this is now, testing your understanding. It's earnings per share is the same thing as net income per share. That's what earnings per share is. It's net income divided by the number of shares outstanding. Okay, so you can either, so again, no preferred dividends. The weighted average number of common shares outstanding. Yeah, actually, I was wrong. I think Ella, I told you the wrong thing. I think you just have to use these numbers. Okay, so when you, so this formula is right. Net income divided by the number of shares equals earnings per share, but this denominator is the weighted average. This is gonna be the weighted average number of shares outstanding. So if you wanted to get the number of shares outstanding, weighted average shares outstanding, you would just do your net income divided by the earnings per share. Okay, and this is going to give you the number of shares outstanding, the weighted average number of shares outstanding, I should say. Okay, so you can see here that we're kind of issuing new shares every year. Okay, the share count has grown. Yes, the net income has grown a lot. It's grown 10x, but our share count has also grown. Not 10x, but it's grown a lot. So your earnings per share is not going to be as impressive as the earnings growth because now, yes, your pie has gotten a lot bigger, right? We saw that in this trend here, right? This net income has gone up 8x, but now you have many more slices of the pie. So if we did a trend analysis of earnings per share, you can see here, I'll just do it on top here. Okay, it's not nearly as impressive. Okay, so the same trend analysis of net income, except now it's per share. We've only doubled, while the net income total, the total pie has gone up almost 8x. Okay, so this is, if you are ever going to invest your own money in stocks, you can't really, if you know, in my personal analysis, I just look at per share data, because companies, they're they're constantly diluting you. Okay, a lot, especially tech companies, they issue a lot of shares, especially in the form of stock-based compensation to their employees. And really, if you want to know what your investments, what returns you're getting, you really have to look at the per share data. The total amount of net income or the total amount of revenue, it's not enough information to determine what your investment in one share is going to give you. Because again, though that pie is growing, you have to see how many slices of the pie are not being added. If you have more mouths to feed, yes, even though the pizza is bigger, your slice may not be getting bigger. Okay, so that's why this per share data and that analysis is really important, because of dilution. And I really, I just wanted to show you that this share count is growing, right? That's a really important piece of information, to know that this business is issuing new shares to raise capital, and that there is dilution that is a factor in your earnings per share. So I think we looked at Merck. Look at their financials right here. Basic earnings or loss per common share, and they give you the amount here. So this is per share. Um, this is the total. This is in millions, and they'll even say unaudited dollars in millions except per share amount, right? So the per share amount is just in actual dollars. So it's $1.72 loss per share. This is in millions though. So it's 4.2 billion, I think. If you do 4,000 times a million is 4 billion. Earnings per share, yeah, we can just reference this data here. Is it per share data? Gross profit percentage. Okay, so now we're going to do some margin analysis, some other type of analysis. These were all kind of geared at um, efficiencies of the balance sheet. Now we're looking at more operational information like inventory turnover, gross profit percentage. Remember, these two in combination are going to determine how profitable our merchandising operations are, right? The spread that you buy low, sell high, which is this gross margin, and then how many times you can rotate. That's this inventory turnover. So these are now operational metrics for our merchandising business. Okay, so gross profit percentage. The gross profit is equal to, if you look up here, our net sales revenue minus what to get gross profit? What is the definition of gross profit? Minus the cost of goods sold, exactly. Okay, so I just calculated the gross profit, and that's divided by net sales revenue. Okay, so again, the formula is F8 minus F12, which is your net sales revenue minus your cost of goods sold. That's going to show you how much gross profit you generated. And you're going to see how much that profit is in proportion to the total net sales revenue. Okay, so you can see that our gross profit percentage is growing, meaning that we're getting better at buying low, sell high. That gap is wider, which is good, right? Because that's our gross profit. So we want that gap, buy low, sell high, to be as wide as possible, because that means for every item we sell, we're keeping more dollars as profit. The inventory turnover is equal to cost of goods sold which is, again, here, cost of goods sold, divided by our average inventory. So I'm going to use the average function. And the inventory, you can see current assets excluding merchandise inventory is one line, and then the second line is merchandise inventory. So I'm going to take, again, the average of the beginning year and ending year balances. So we have this double good effect. We're not only increasing our margins, we're also increasing our inventory turnover. So we've improved on both of these levers that a merchandise business has to generate profit, which is, again, having a larger margin between buy low and sell high, and also how many times you can complete that transaction in a year, how many items, how fast you're turning over your inventory. So we're doing better in both of these over the years. And that's what, again, that's translating into that much higher profit, right? We can see all these things are linked together. But now you can kind of see how, like, the different components. It could have been that maybe our margins have grown a lot, but our inventory turnover is the same. And so you would know that, whoever's in your purchasing department is either doing a good job or your sales team is doing a really good job selling for your product at a higher price. But the volume is not really changing, that volume of turnover. Okay, so the breakdown allows you to analyze your business and tell you something about what's going on. And you can just see that kind of everything is working. This business is doing really well. Now, this requirement 4, these are all dealing with uh, the ability for your business to pay its current liabilities. We had those ratios, the current ratio, the acid test ratio, and the also known as the quick ratio, and then the cash ratio. Okay, so we had those, and it's also asking you to calculate the debt ratio, which is answering the question of leverage. So the theme of requirement 4 is around leverage and ability to pay debt. Okay, so that's kind of the theme of these different ratios that we're calculating. So acid test ratio, cash plus cash equivalents plus short-term investments plus net current receivables. So essentially, this is everything except for inventory in this case. Okay, it's the most liquid current assets divided by the current liabilities. So they've made it quite easy because they have this line item. It says current assets excluding inventory. So all I have to do is take this divided by my current liabilities. So remember, the most lenient is current ratio, which is all current assets. Then there is this quick ratio, quick / acid test, which is like a middle ground where you're getting rid of the less liquid current assets, of which inventory is kind of not that liquid, right? It may take months to sell your inventory. So that's just going to be this cash plus short-term investments plus AR. With AR, typically you're going to get within 30 days. So that's like pretty liquid. And then there's the cash ratio, which is all just cash, right? It's the most stringent. So this is kind of that middle ground where we're just using the more liquid current assets. Okay. The current ratio is all current assets. So now we do the same thing and we add in inventory. So we have this plus this divided by current liabilities. And you can see it's always going to be higher. This is always going to be the highest current ratio. This is going to be second highest, and this is going to be lowest. Okay, so and you can see that reflected here because, again, this is the most aggressive, meaning you assume all your current assets are available to pay off your current liabilities. This one assumes that only the most liquid are, and this is obviously the most liquid, which is cash. Okay, and then the debt ratio is equal to your total liabilities divided by total assets. So again, this is just going to be your total liabilities, which is, I guess they're not giving you to directly, but it's your current plus long term. So it's these two divided by your total assets, which is given to you in line 27. So you can see here we've been financing our balance sheet pretty much give or take 50% debt and 50% debt, 50% equity. It's a 1-to-1. Okay, so if you had calculated the debt to equity ratio, it would be 100%, meaning a 1-to-1. Instead of getting it right on the homework, I think it's more important you understand what these different ratios are and why they change, right? What is the difference between cash ratio and quick ratio? Like what is causing that difference? Why would you want to know quick versus cash? It's just more conservative versus there could be a case where your accounts receivable are much longer term. Maybe you give credit terms of like 90 days, in which case you're like, well, then the quick ratio I don't really want to use, right? I'd rather use the cash ratio. So you, as an analyst, also have to use your brain and think about the context, think about what these different things are, and not just like look at the number. You have to. It's good to understand where they're coming from and why they're relevant. And then debt to equity. Okay, so it's asking you to calculate this. So total liabilities, which again is current plus long term, divided by your total equity. And again, as I said, these are all kind of related. Okay, this 50% is related to a 1-to-1 debt to equity ratio. Okay, so um, these, I think this is a more intuitive. The debt ratio for me is like more intuitive. It's just showing as a percentage what percent of the assets are financed with borrowing. I think it's more intuitive. This one is, you got to like what a 2.0 is two liabilities for every one equity, and that, I don't know, it's just less interpretable for me, but you may like it, whatever you like better. Times interest earned, net income, and again, we're taking net income, we're adding back income tax expense, we're adding back interest expense to get the total pool of profit available to service your debt. That's why we're adding these other things back. Okay, so I'll do net income. Yeah, so actually, there was income tax expense. So that formula we did for what was it, asset turnover or return on assets is incorrect. You do need to adjust the income tax expense. Okay, by I think it's like 1 minus your marginal tax rate times so there's some adjustment because your income tax is tax deductible. So if you were trying to figure out your pre debt service income, you also would have to reduce this income tax expense because the income tax expense is slightly lower because you have interest. Okay, so so it's not quite right. The book was wrong. And again, this is why the AI is not going to replace a thoughtful human. You have to understand what's going on here. Okay, because maybe it'll just give you the unadjusted number because it's reading this and this text is wrong. It's just it didn't give it to you correctly. Okay, but anyways, let's just go back to this. And we'll just follow the formula as it is. And then I'm not going to do plus because again, this is a negative sign. So I did minus. Okay, so now that divided by your interest expense. And I'm just going to put a negative sign because I don't want this thing to be negative, but you just divide it by this interest expense. But again, I put a negative sign in front of it to make it from a negative number to a positive number. So that's why this negative is here. Okay, so this is also just a ratio. Okay, so as we've generated more profit, we have much more ability for us to pay off our debt. Okay, and then finally, I'm just going to finish this off because I still want to do a couple more things. So the dividend payout ratio, again, the business has generated some profit. Okay, so let's just make sure we're clear on this. So the business generates a profit. Okay, so there's profit. Let's say it's $1,000. Now it has two decisions that are. It has two options of what it can do with that profit. It can either return it to shareholders. Okay, so we talked about the different ways that this is done. This is done through dividends, and what else? There's another way we talked about: issue shares, right? And that causes a dilution of per shareholder earnings. What is the opposite? How can we do how can we do anti-dilution? Treasury stock transactions, where you're buying shares back, you're spending money to do that, and that's a way that the earnings per share grows actually, because you're reducing the number of mouths to feed essentially, right? You're taking shares off the market. Okay, so this is also achieved through treasury stock, also known as stock buyback. The other is what? What else can it do with this profit? Keep it. We call this retained earnings, right? Because remember, if they returned all of this as dividends, we would have, let's say we had $50,000 of starting retained earnings. We would add the $1,000 of net income. But then if we paid all of it out as dividends, our ending balance would just be 50K. We would not have increased our retained earnings. So if we choose to not do this and retain this, then this goes away. And we now have 51K in retained earnings. So now we've kept that net income within the business and we're now buying more assets with it. And it's not one or the other. You can do both. You can return some of your profit back to your shareholders as dividends and then retain some of it. So what this dividend payout ratio is figuring out the split between these two options. Okay, and it's not quite accurate because instead of paying a dividend, you could have bought back stock, and that's not going to be captured. But some businesses, again, you have to know something about the stock you're investing in. Some stocks, they're dividend payers. They attract investors by having a very steady dividend. Okay, so if that's the case, then the dividend payout ratio is meaningful. But like for a company like Berkshire Hathaway that never pays a dividend, but does buy back stock from time to time, the dividend payout ratio is meaningless. Okay, it's not going to tell you what you're trying to figure out because they're achieving returning capital back to investors through stock buybacks. And like some do both, like Costco, they do dividends and they do stock buybacks. So now that stock buybacks are so common, it's like the dividend payout ratio is kind of becoming like not that useful because you actually have to look at the totality of what they're doing. Okay, but anyways, just so we calculate it, so dividends per share divided by earnings per share. So we look at the dividends per share, which is this, divided by the earnings per share. This is telling us basically that for every dollar of profit that the company is generating for the shareholders, it's keeping 80 cents of it and it's paying out 20 cents to the shareholder. Okay, so and it looks like it's pretty steady. They have like a pretty steady payout ratio. Okay, all right. So I don't know what was number 6. Should you invest in the common stock? What do you think? There's one big piece of information that's missing to answer this question, in my opinion. Yes, the business fundamentals are great. We saw it is doing great profitability wise. It's doing great on margins, inventory turnover, return on equity. But what is the key piece of missing information to make this decision? For sure. Exactly. Exactly right. What is the dollar? How much is it going to cost to get this phenomenal business? Because there is a price that's going to be too high. Okay. If you own a 7-Eleven and it generates $100,000 of profit per year, if you could buy it for $500,000, it's probably a great deal because you'll recoup your money in 5 years. If that same business is selling for $50 million, it's a great business. Maybe it generates $100K per year steady and there's low risk, but that price of $50 million is just far too high. Okay, so this is a whole different question. Okay, we can use the financial statements to look at the fundamentals. but then you have to see, is it worth the price that the market is kind of asking?